Hi, it's Frank Cappelleri from Cap Thesis. It's a pleasure to be with you here again on Stockcharts TV. So we're going to focus the first half of the video on the S&P 500 and then turn to other areas like small cap growth, biotech, Bitcoin, which continues to struggle. And then lastly, we're going to look at one of the most compelling charts out there from an area you probably don't hear about too often. So let's start with the S&P 500. And so this is a data table which we show our clients at the beginning of every piece, just kind of a snapshot of what's been going on over the last 4 weeks. And as we can tell, mostly blue, obviously some bullish activity with some good closes above the midpoint, mostly positive breadth, but not recently. In the last 5 trading days, we've had 4 days with negative breadth, with a few of them below 30%. So in big picture, not a big concern, but when you have a cluster like this, especially with a market that is hovering near its highs, not really getting too many strong breakouts right now, it's a concern. And so if you look at this more closely, we were just talking about how the breadth was supportive in the fact that both the S&P and the advanced decline line were moving higher in unison. And so you can't really have much more than that. But as we know, things change pretty quickly sometimes. And we had a lot of very high profile earnings last week. We had the Fed cutting rates, which many people are calling a hawkish cut because of Powell's testimony afterward. But as we stand now, after Monday, November 3rd, there's a divergence in breadth here, right? S&P still kind of hovering near its highs. The S&P 500 advanced decline line now below that. And so another way of looking at this is, of course, comparing the S&P 500 to the RSP equal weight ETF. And so if you go back to that big down day on October 10th, when the S&P was down 2.7%, both the S&P 500 itself and the RSP equal weight ETF got hit, obviously, very hard. And both of them immediately turned, right? The next week rallied very strongly, with both of them, the S&P and the RSP getting back to the respective former highs relatively quickly by the 27th year. In fact, as we know, the S&P continued to advance above that on the back of some of the mega cap stocks doing well, while the RSP did not. And if you go back to, again, when this really started here, right, we see the same type of thing. As the breadth started to deteriorate, of course, we see it much more clearly in the equal weight index because it was just not influenced on in a very aggressive way by the Mag 7 and the like, where this is the average stock, what's been going on, showing that most of the time, at least over the last week and change, they've been moving lower, right? And so that's a concern, especially if that means the S&P has to catch down to it. Because if that happens, we know that means also that the biggest names are causing the damage, and we know how that can have an effect on everything else. We've seen it before. And so midday here on Tuesday, November 4th, the pullback from the most recent high stands at about 2.3%. And so that's not alarming by any means, just by looking at the numbers, and compared to what we've seen since June, it's pretty much in line with the biggest pullbacks, just because the pullbacks haven't been big at all. As we know, the biggest drawdowns have been about 3.5% from the end of July to August, and there's also one just about the same amount at the end of May, all leading to extremely good buying opportunities. And so we're talking about this last week when the pullback was even shallower at that point. S&P was only down about 1.2%, noting that if that had been the end of it, I mean, if that was the low that investors came back in to buy the bid, it would have been amongst the smallest pullbacks, the smallest of the small that we've seen. And considering that at the time, the 14-period RSI and the 2-hour chart was right near 50 as well, it just seemed like it was destined to have at least a little bit more of a pullback. Because the last few times this has happened, especially since August, volatility has picked up, even though it really has been non-existent in the historical sense, just a little bit more than we saw from May through June and July. And so that has resulted in this 14-period RSI coming back down and hitting oversold territory each time. Again, that was non-damaging to to the uptrend, but that was needed for the bid to return in aggregate. And so depending on how Tuesday ends up, and of course how the rest of the week unfolds, this very well could get oversold once more. And we'll have to see how far that takes the S&P down from its highs at that point. And so in terms of the bullish patterns that we've been tracking, the majority of them have played out for the S&P 500. We've had 5 successful bullish pattern targets hit up to this point, the most recent one being a smaller one after hitting 6,900. And so with the pullback, again, from the middle of October and the rebound back to the 6,750 area and above it, that triggered the 6,950 price target. And we had that initial very strong follow through right away. But now, again, over the last 5 or 6 days, that has come back. And so as we can tell here, based on the colors we use, which we can find on stockcharts.com, of course, this breakout zone is being tested. So we're in the danger zone right now, where if we pull much further back into the red and underneath this area, of course, that could negate this upside target. Again, one bullish pattern being nullified isn't a big deal, but if that starts to happen over and over again, obviously that would tell us that momentum is fading, buyers are getting exhausted or just impatient about not having their buys get immediately rewarded with new all-time highs and then some, like we've seen over the last number of months. And we talked about this before, but one of the key markers from late 2024 through early 2025 was, yes, breadth started to deteriorate. We know we started that December with 14 straight negative breadth days for the S&P 500. As that was occurring, large cap tech was holding up, but the breakouts that we saw, those attempts from the S&P, were failing. And marginal pushes above 6,100, nothing really stuck at that point, eventually leading to not only the waterfall decline that came after that, but before that happened, the formation of bearish patterns, right? Having those play out. And that would be the next step, right? If this gets negated, then we'll have to see if a topping formation then takes shape and, of course, see how that is dealt with. And so this will be an important one to watch as well. This is the go, no-go chart, which we talk about a lot. And with these red arrows, they signify counter trend moves. And it just means that the S&P has come off an extreme level and it's pulling back. And as we can tell, that is yet to lead to anything more meaningful. With it happening again now, this being the 8th one we've seen since July, we'll see if this does anything different. Again, we use this to complement other indicators that we use, the pattern work, of course, as well. And we know one thing is that every big downturn that we've seen from a preceding uptrend has started with a counter trend arrow like this, but not all counter trend arrows lead to that type of rollover, just like every other indicator. Probably going to see a MACD sell-signal trigger at some point now if we get some more downside follow through, so forth and so on. So we'll see if this does anything different this time. And so looking at the same data points here, right? Talking about two-way volatility, and of course we are referring to the number of 1% moves. And this has been the backbone of this uptrend, with them being so infrequent since really mid-April. But things changed a bit in October. We know, again, that first 2.7% really strong down move on October 10th was immediately met by strong buying. As we know, over the ensuing 2 weeks, had 1% gains and just a lot of very strong closes. The breadth was strong as well, but that hasn't lasted. So we had, from that point, for the month, 3 1% gains, 2 1% losses. Doesn't sound like much, but it's much more than we've seen recently. And we can see that here, just looking at all the 1% moves going back to April 21st. And we think that is a very key point as well, because that's an obvious higher low compared to the massive volatility here. And as we can tell from there, we had that 1% decline and then 3 straight 1% gains. And really that is what changed things. That's what, got the market to get slingshot back above some of those obviously very volatile days in April. And then from that point, as May started, what happened? Started gaining hardly any 1% losses at all. Even the 1% gains started to get much more infrequent. And needless to say, that has led to the uptrend that followed in the bullish patterns that have been playing out so well. And so we bring it to now, again, October, there's a cluster of them. And as of right now, it looks like we're going to get potentially another 1% decline. So you potentially have 3 1% declines, 3 1% gains. So 6 1% moves in 3 or 4 weeks, right? And that's much different than what we've seen since the April low. So something to keep in mind, again, bullish patterns failing, higher amount of two-way volatility could lead to a lot more volatility or a lot more market indigestion, if nothing else, right? And so again, we saw how that played out before that, right? In the end of, from the beginning of 2025, collection of them, back and forth movement, then nothing, and then all of a sudden things fell apart. And of course, we had more 1% gains and losses than not during that time. And just two-way volatility just means that you can't trust bullish patterns. In fact, bullish patterns can't even really form that well when you have that many sharp moves and acute turns over and over again. So that's something obviously we'll have our eye on in the days and weeks to come. So turning to small cap growth, now this is a different way of looking at it. We know that the IWO, the small cap growth Russell 2000 ETF, has been percolating close to new highs. And this is a pretty clear potential massive inverse head and shoulders pattern as well. This is monthly, and this is log scale. So this is going back all the way to the beginning of 2021. So it would be really substantial if that worked out. So question is, will it at this point, right? Because some of the meme stocks, as we know, have been blamed for this rally and think that, bears, of course, think that this is going to lead to the bigger downturn that we're still all been waiting for. And as we also know, a lot of times over the last few weeks, the most recent rally, right, in these small cap growth names, in the likes of ARK, so forth and so on, has been compared to what we saw in 2020, which obviously has played out very well up to this point, with the concern is that we could be at the end of that, and it could be very similar to early 2021, which is when many of those meme stocks topped, including ARK, right? And so, needless to say, that is something that we can't ignore. Now, the question is it really just like that period back then? Well, we can compare IWO to IWM, and from this point, right, from 2017 to the end of 2019, IWO was outperforming. I mean, small cap growth was doing better than small caps overall. And it was a pretty consistent uptrend, but nothing too parabolic until right after the COVID low, right? And it's really ripped higher, kind of flat line, meaning that IWM, the Russell in general, caught up, and then the meme stock explosion, right? With GameStop, so forth, so on, blowing up. And we know that IWO just completely unraveled. Small caps, speculative stocks, so forth and so on, topped in late January, early February, even as the S&P 500 continued on through the rest of the year. So looking at currently, we've had the same ebb and flow like uptrend with the IWO, IWM ratio making higher highs and higher lows, but it's been pretty jagged. It's not like they've really taken control at this point, meaning that we haven't gotten to this point yet. We haven't seen the small cap speculative names really outperform small caps, or basically value at this point. Do we need that to happen before this type of thing happens, before we see the big rollover? No, but it also gives us an idea of how different that time was compared to now. And so if this most recent volatility that we're seeing now over the last 2 days can be dealt with better, then a lot of these stocks maybe could regroup and begin to continue, to ride or build this base with an eventual breakout coming, but just not yet. So if you like this kind of content, again, urge you to check out capthesis.com. That's our website here. As you can tell, we have access to free content. You can check out the premium services as well. There are a number of free samples. Again, we look at the S&P. We have 175 ETF universe we comment on a lot and provide chart trades nearly every day as well, with specific entry and exit levels, both as target prices and risk levels to be mindful of. Again, capthesis.com, and please reach out with any questions. So if we're going back to the presentation, as we know, for small cap growth continuing to work, of course, a big piece of that is going to be biotech, because biotech is the biggest piece of the IWO, has the biggest footprint in terms of an industry. And, it's been doing a very good job, breaking out from its own cup and handle pattern, including breaking above this downtrend line, which extends all the way back a number of months. We just wanted to zoom in and show this period a little bit clearer here. And so along the way, after that breakout occurred, it eventually did hit the target near 102, and it did so by neatly tracing out these trading boxes, which we talk about a lot, right? There's, let's see, 1, 2, 3, 4, 5, 6, 7, potentially on the 8th one. So far we've had 7 successful trading box breakouts, with this one, of course, being tested right now. And again, do we need each one of these to work out? No, we don't. But so far they have been. That has allowed XBI to continue to advance and also to continue to lead small cap growth. So as of now, it's through a very important resistance point, to the point where we haven't seen XBI at this level in between 110 and 115 since early 2022, which was, as we know, in the middle of an excruciating downturn, which finally bottomed in the spring of 2022. Now, we say bottomed, it hasn't gone below that, but it hasn't done anything else either along the way. It's been a very frustrating and long few years for XBI traders expecting a return to this level, of course. And we can't really say that's going to happen until XBI shows that it can continue to leverage those trading boxes into something more. But being able to finally get above that is really attracting a lot of attention for obvious reasons. And to give us an even clearer idea of how strong this rally has been, the 7-month rate of change, right, just got up to about 40% as of the end of October. And the last time we saw that, of course, with 2 prior examples from the middle of 2020 here, and also in 2016. And both times, needless to say, XBI continued to advance. Had a few more months left until it topped in 2021. It had much more than that, about a year or so, into 2018. So we've seen strong moves, but nothing like this in quite some time. And when we've seen 7-month rallies of at least 40% or so, it led to more of the same, even though that pace eventually slowed. Now, the other part of it is that the move from the low is about 70%. And again, through that key resistance area, which we just talked about, where we saw very similar pattern breakout from, ironically, around the same price levels last time as well, back in 2020, that eventually yielded an ultimate move of 180%. And so, again, it's not always apples to apples, but this is an indication what can happen. Momentum really picks up and also shows that we're not nearly at that point where we were at the end of 2020, early 2021 for speculative areas like XBI. So Bitcoin, as we know, continues to struggle. And we've talked about how it just has not gotten the momentum to really push above those new all-time highs. The marginal new all-time highs all on the way over the last few months, but not getting too much more above 125,000. And so each time it's failed, we've seen tops form. We can draw these all different ways, but these are the most visible, from my opinion at least, with this recent rollover obviously getting some steam. And so we have highlighted here the previous downside breaks were temporary, leading to strong rallies each time. We know those rallies eventually faded. And now we're getting to the point where the most recent one, the bounce once again happened just a few weeks ago, but it was extremely shallow compared to the last 2 that we had. And that was easily sold off into. Now we have another downside break getting close to 100,000, an extremely important level psychologically, especially from a round number perspective as well. And it's getting very close to being oversold for the first time in quite some time too. And so, needless to say, it's been underperforming for a while, and this continues to roll over. It would just be hard for equity investors to ignore as well. And it could really, potentially lead, the market's risky assets overall lower. So it's a big concern, even if you don't care or trade in Bitcoin. And so what that has done it's taking it below the risk zone. So it's getting very close to now undercutting the right shoulder of this very substantial inverse head and shoulders pattern. And we're talking about for quite some time, obviously has not achieved its 142,000 target. And at this point, then we can say that it's done a very, very poor job, especially compared to what we saw last year. And, we were talking about it, others were as well. Didn't really take advantage of the typical positive seasonality that it's shown in October. In the previous 10 years, it was up 9 times during that month, and pretty substantially so. So that is obviously going to be negated too, unless we see some sort of really strong bounce relatively soon. And so that brings us to the long-term uptrend line on a log scale, which dates all the way back to the 2015 or this late 2014 low, with each of the biggest pullbacks along the way touching that or getting close to it, leading to the ensuing strong rallies. And so that's happened again as well, right, from 2022 low. But the breakout kind of petered out of about 70% or so. Again, nothing bad by any means, but in terms of Bitcoin's perspective, it's underperformed the previous breakouts, which were 2,700%, 250%, obviously getting more difficult to emulate those type of numbers as Bitcoin itself is higher and higher. The most important thing, though, from this whole chart is that it's getting close to that uptrend line once more, right? And so seeing if that holds, and again, it's going to be coinciding with 100,000 or just below it, right? That's going to be obviously a spot that many eyes will be on because of it. Okay, lastly, let's look at, you guessed it, corn. The reason why I wanted to talk about it is if you just look at this chart with no lines on it, it just looks like a basing pattern, right? It was in a pretty strong downtrend. If you take this chart all the way back, you can see how many years it's been moving lower, right? And not much more than just a few bounces along the way. But this one looks a little bit different. In fact, if we put some lines on this chart, we can see that there is not only one big potential cup and handle pattern here, there's actually 3 different bullish patterns happening all around the same price, right? Cup and handle pattern, we see that if there's a breakout, gets us up to about 19.5 or so, and we hadn't seen levels like that since this May. And this whole handle of the cup and handle pattern within it is being constructed with 2 other bullish patterns involved, with this bigger potential inverse head and shoulders pattern in black and even smaller one in green. And we don't need each of these to work out for this pattern to be completed, but just knowing that there's been enough going on from different time frames for these patterns to be formed simultaneously tells you that there could be something to this pattern, right? And of course, if you see corn going up, you think of agriculture, think of commodities in general, and that also brings us to inflation, right? And so we're not saying that corn itself is going to be the indication of inflation going forward, but seeing it move higher is not going to tell us, or not going to give us a great feeling that inflation is contained. So at the very least, let's keep an eye on it. From a big picture point of view, it may give us an indication of what inflation is actually doing, especially for agriculture. But if nothing else, if we're looking for bullish patterns, which we always are, it doesn't matter what this chart is, right? A lot of times I'll bang through many charts as possible manually just to get an idea. What does my eye catch, right? What does it see? In fact, I was at a CMT symposium a few years back, and the great Peter Brandt, who has made a career, literally 6 decades of trading chart patterns, was giving a presentation. I was in the front row, of course, for that. And after he gave the presentation about what he was doing within the markets, specifically commodities and futures, someone asked a question, well, how long do you have to look at each chart before you really think that you like it? And he said, no more than 2 seconds. Everyone laughed, and he was like, I'm not kidding. It's like 2 seconds. You either know you like it or you don't. And so when I did that just recently and going through a bunch of charts, this one popped out at me in about a second because it looks so much different than other areas right now, which is showing a bottoming formation that is yet to be taken advantage of. And again, probably not many people are looking at it. That's what we have for today. Thanks, and I'll see you again next time.